Hello and welcome to this ISM Trust webinar on tax for musicians. I'm Ruth McPherson, Head of Charity Development at the ISM. To describe myself, I'm a white woman with mid-length brown hair and I'm wearing a leopard print jumper and the ISM Trust logo is behind me. I'm delighted to be joined by Street's Carr Accountants Manager, John Donegan. John joined Street's Carr's Brighton office in 2021. Prior to specialising in tax, he focused on audit work. And based on his experience, his work centres on the provision of accountancy, software training, and tax planning. His clients include those just starting out, as well as established artists in the media and entertainment industry. He's also experienced in working with and supporting startups and small and growing enterprises. Before we begin the webinar, just a few things to note. During the presentation, please feel free to ask questions using the Q&A function, and we'll do our best to answer your questions at the end. And do keep an eye on the chat box where we'll be dropping in some useful links as we go. If you experience any technical difficulties, just let us know in the chat box and we'll do our best to resolve them. And if you wish to use them, subtitles are available to enable at the bottom of your screen. The webinar is being recorded and we will share the recording with you afterwards, as well as a feedback survey, which we'd be very grateful if you would fill out. The ISM Trust is the ISM's sister charity, which offers high quality professional development to everyone working in music. Through the ISM Trust, the ISM gives back to the sector and supports and empowers music professionals to succeed. We produce award-winning events, training and resources which are largely completely free to access. Please do consider supporting the work of the ISM Trust by becoming a friend, making a donation or leaving a legacy. Any support that you can offer us is much appreciated. Now, without any further ado, I'm very pleased to hand over to John, who's going to help us to understand more about the process of paying tax, expenses and filing your tax return. So thank you, and over to you, John.
Hello everyone, I'm John Donegan from Street Smart Carr. I'm an accounts manager here. I am a white cis male wearing a yellow shirt with a yellow checkered t-shirt over it and some funky clear glasses. I will now start to share my screen and hopefully get started. So before we start, I do just have to give a bit of a disclaimer. This is general advice on the accounting and tax system. Almost everyone in media and entertainment industry can be dealt with by a case-by-case basis. So one rule may not apply to other based on the circumstances around that. But to begin, just a bit of background about our firm. We're a national firm of accountants and tax advisors. We have over 20 offices in the UK, plus international connections, so we can help with any international aspects of foreign income as well. As an office, we have over 25 years of experience in the office. So hopefully we should be able to put you in the right direction when it comes to your finances, tax planning, and any general queries you may have. So my background, Bruce mentioned, I've been in the profession for over 6 years now, starting in audit and now specialising in tax. I deal with accounts preparation, VAT and stamp taxes, taxation of individuals, corporation tax, owner managed businesses, cryptocurrency for any of those that might invest, inheritance tax planning, and taxation of major corporates. My goal for this webinar today is to kind of guide you through the process from start to finish, from registering to the dreaded deadlines. These are the kind of 10 topics I'll be covering: identifying income, do's and don'ts of record keeping, various softwares you can use to benefit you, the reason you'll probably all hear, the expenses and capital allowances, what can you claim. I'll briefly touch on foreign income and withheld tax, because that, again, is something that can be a case-by-case basis. Student loans, for you, those of you who have it. How to treat pensions. The difference between being self-employed and acting through a limited company. and finally on the deadlines. Okay, so my first slide is about identifying income. So firstly, what is it and when do you need to register? Trading income is anything related to your goods or services. Let me just find myself. That relate to your trade, profession, or vocation. The registration threshold for self-employed income is in the UK is £1,000. If you earn £1,000 or less, you can claim the allowance for that and won't need a return submitted for that. However, there are reasons you might want to voluntarily register in advance of earning £1,000. This might be if you need to prove you're self-employed for future opportunities, or to claim tax-free childcare, to make voluntary Class 2 national insurance payments. So you might ask why you want to do that, but that is so you help to qualify for benefits that you may be entitled to. So gaining contribution years to your state pension, or maternity allowances in the future as you may need them. And to claim certain tax reliefs that you may be entitled to. So if you are just starting self-employed income and are under the threshold, for example, some losses can be set off or carried forward against future profits or PAYE income in the current and prior year. So there may be benefits to registering earlier. The choice is up to you. And once you recognise this income, you will need to know how to register. It's not as scary as it sounds. HMRC have updated this recently. It is something that has to be done by the individual now. So you'll need to firstly create a government gateway account. So you do that by going onto the HMRC government gateway. Hopefully there will be a link to that in the chat. From here, all you will need is some basic information about yourself, an email address and a phone number. The government gateway itself is quite quick to register. It takes about 5 minutes. Then once you have your government gateway, you can then register for self-assessment. Self-assessment is where you'll need the extra information, such as some sort of photo ID, a P60, a recent payslip, or it will ask you a multiple choice of security questions to get to know you, like credit checks. So it could be who do you bank with, when was the last time you took out a car loan, or who you took out a car loan with, something like that. But it should be something you are able to answer. And then once the accounting has been done, you can prepare yourself, or an accountant can prepare them for you. If we were to file it for you, we would do that, the accounts and tax return for you, send them to you for your approval before sending them off. That is the most important part, to check you're happy with it. If you want to do it yourself, there are MTD compliant softwares that can do this for you. By far the easiest route if you are doing it yourself. Or if you want to submit it outside of a software, there is an online guide, you can do that. However, software is easy as it picks up your expenses and allocates them to the right categories for you. If you are filling it out through the gateway, you only need to fill out the parts that are relevant for you. So there are different sections in tax return. So for example, if you are just doing self-employment, and you have no PAYE income or no rental income, for example, you just leave those parts blank. Don't submit a 0, because then next year they will expect one. Just leave them blank and they will remove themselves. Or if you do this for a software, it will know for you. Then once you've completed the relevant parts of the income you've received and expenses you have made, you can submit your tax return. Once you've checked it, our best practice is to keep a reference of the submission number once filed. Every now and then, it is rare that HMRC may not receive your tax return. If you save the submission number, that is your cover for any late filing penalties that they may issue you. It's always best to keep that somewhere. And once you're ready to pay, payment can be done easily by bank transfer. The details will be on HMRC's website. Gives you the sort code, the account number, The only thing that's personal to you when paying is the reference. So the reference for payment of your self-assessment will be your 10-digit UTR number. You will get this when you register for self-assessment. 10 digits long, and you just have to follow it with a K at the end for the reference when you're doing it by transfer. You can pay online once you've got your government gateway open and active. Bank transfer is fine. So I think the second most important thing for your tax return is the record keeping. I just want to quickly go over the do's and don'ts. So record keeping is a must for anyone earning any type of income. Does not matter if you are PAYE, rental, self-employed, or through a limited company. The length of time you need to keep is does vary per tax, annoyingly. Self-assessment on the screen there, it says it has to be at least 5 years after the 31st of January for your relevant tax year. So, for example, this current tax year, 22-23, that we're submitting this year, is due by the 31st of 2024, which is rapidly approaching. So you have to keep the records for 5 years from then. So it'll be 31st of January 2029. For that, it is at least 6 years after the quarter you've submitted. For corporation tax, it's at least 6 years from the end of the accounting period. And how to keep your records as well is important. You can keep them physically. That does take up room and potentially costs of storage. You can keep them electronically or through bookkeeping software, which I will touch on shortly. But your records must be complete. They have to show the date. They have to show what the full cost of the receipt was. If you've only purchased half of that's 2 items on the receipt and only half of it's for your business trade, you do need to highlight that and just keep that safe as well. It has to be a full receipt, not just half of it. So it is ideally best to put them away and not just keep them in your pocket, because that does tend to cause them to fade and then not always be readable. And invoices as well. When you are invoicing someone, your invoices must include the following things: your name or trading name. So if you're a sole trade, so for example, I could be John Donegan. If I wanted to do an accountancy, but I could trade as JD Accounting, for example. It just has to be one, and you have to stick to it. It must include the address of the business or the trade. So if you're working from home, that would be your home address and your contact details. The date of the invoice and the date the invoice is due to be paid by is very important, because that will let us know when the tax period is. In the body of the invoice, you'll want the description of the work. So what you've done. So say, for example, if you've done 5 days, you'd want to say for 5 days from X to Z, and you've got detail of what you did there. It's important to keep that on the invoice, because it may be you invoice, say, the 6th of April in the next tax year, but if the work is relevant to, say, the 25th to the 30th of March, it will need to be included in the prior year, despite you invoicing after. So it is important we get that whole period correct. Also on the invoice, you want the fee calculation. So say you have daily charge of £200, you'd have 5 work days work 5, cost of £200, total £1,000. What else we want there is bank details, so you can receive the payment, because we don't want to do the work without receiving the payment. And if you are VAT registered, your VAT number needs to be shown separately, and the number has to be on the invoice. Without the number being on the invoice, it's not a valid VAT receipt. And just one quick on VAT, the VAT threshold for registration is £85,000 of UK income. And if you go over that in any rolling 12-month period, you will have to register for VAT. It's not just apply for your financial year. So April to March, for example, it could go from September to August. You could fit that threshold. That is something you would need to keep an eye on, especially when you're starting to reach those higher figure income. You'll need to keep an eye on that. So software you can use. There are multiple multitude of cloud-based softwares. We would recommend cloud-based softwares as it just gives you that ease of access. You can access it from anywhere. Your accountant can email it, access it from anywhere, or your bookkeeper can access it from anywhere. And with cloud-based software, you can connect your bank and have a live bank feed, and that allows us and yourselves to keep live information on a monthly, quarterly, 6-monthly, or annual basis. And it just helps the flow of things. And also it means we get the information on time so we can prepare things quicker. And we can stay on top of it and be active rather than reactive. The common three are Xero, QuickBooks Online, and Free Agent. You've probably seen advertised. As a firm, we generally use Xero more. We are certified to use all three. I'm certified to use all three, so I'm an expert on all softwares. So any questions you can ask me. I do just want to mention with Free Agent, if you do make a business bank account with NatWest or Metal is like a bank like Monzo, you just do it through your phone. They will give you a lifetime license for Free Agent currently, which means you won't have to pay for it as long as you have bank with NatWest or Metal. This will be important because making tax resort is coming in the next 2 years, and everything will have to be submitted through some sort of software. So it is probably best to start working on that as soon as possible. But in the meantime, if you are earning smaller figures, we can just do expenses and income through spreadsheets for now. But it is just something to keep in back in mind. So having software has a multitude of benefits. Invoicing can be done from the software, and it will track your paid and outstanding invoices and receipts, which is great for credit control, making sure you're being paid what you're supposed to be. It's just great to have an idea of that. And you can always track your turnover as well, so you don't have to manually add up everything. On Xero, you can run QuickBooks and Free Agent, you can run a multitude of profit and loss reports, which can track your turnover over any 12-month period. So this can be something that can be checked monthly. And circling back to the record keeping, there's Dex, which was formerly known as Receipt Bank. Dex is a software where you take a picture of your business receipts as you get them, ideally. And then once you've done that, you bin the receipt, Dex has to cover for you. It'll read over your receipt and fill out a bill to pay on your accounting software. And again, it will read where it's from, how much the bill is. If you're VAT registered, it will calculate the VAT on it. The date the purchase is made, and it will also keep the electronic copies as well, so you don't have to keep the physical ones on you all the time. You can just bill them. So expenses is probably the reason most of you are here. It's also kind of the most case-by-case kind of topic as well. So I just kind of wanted to run you through firstly what a claimable expense and some of the claimable expenses you can make. So a claimable expense is something that is incurred for the furtherance of the business. A few examples of these are office, travel, staff costs, financial costs, marketing and training. With things like your mobile phone bill and internet bill, if you're working from home, as a lot of entertainers do have some of that element. Things like that, the full cost will rarely be able to be claimed, but because an element of it is used for business, we can make that claim for you. We will advise on a percentage to claim, or you can advise us how you feel the bill should be split. This can range from 30% business to 7% business. It all kind of goes on kind of questioning to and from. Travel costs. So fuel, parking, train and bus fares are claimable to an extent. When you're traveling in the car, it is important to be aware that you either can claim your fuel allowance, your fuel as you top up the car, or your mileage. Personally, I would prefer mileage. It's 45p a mile up to the first 10,000 miles, and then 25p after that. And that also usually does cover insurances and wear and tear. So usually it kind of comes a bit of a bigger cost than your initial fuel receipts would. And also if HMRC do query it, it's kind of easy to say, oh, this was business mileage rather than around fuel receipt. And it's something to touch on training courses related to your business. So, for example, if you are a guitar player and you were taking the guitar course to kind of refresh your skills or advance your skills, we would be able to pay that in the same year. Again, if you're a guitar player and you want to take a songwriting course, we wouldn't be able to include that expense in the tax year, as it's likely you wouldn't have any income associated with it yet. So what we could do on your balance sheet is we'd have it as a prepayment. So we'd keep it on your account as such. And then as soon as you started doing some songwriting and earning revenue from it, we release that expense into your profit and loss, and that's when it becomes tax deductible. So just to reiterate, sometimes expenses do blur the line between business and personal. HMRC will try to argue against the full claim. But we can argue with this. If HMRC do that, we can advise and we can help on that. From our previous experiences, HMRC will understand that. Yeah. So travel and subsistence, I just wanted to touch on a bit more in detail, just because it can go too far. So whilst claimable, you need to be careful what you are claiming. So if you're consistently going from your place of home to a studio, for example, that will be seen as just you going to your regular place of work. That would not be an allowable expense. If you were to go to, like, so for example, if you're in London doing that, but you have enough for you to go to a Manchester studio for a specific job, that travel would be claimable because it's not your regular place of work. But yeah, anything like is usually not fun. And subsistence is the same as well. It can be claimed when traveling away from the normal place of work or home. It's not really something that can be justly claimed because you are working late and got home a bit late, unfortunately. Again, with this kind of expense, you do need to keep receipts or mileage. It is important. And again, 45p a mile for 10,000 miles, then 25p a mile after that. And just because we get this question a lot, entertaining. Staff entertaining is a tax deductible expense, but client entertaining is not. So by that, I usually mean if they're on your payroll, it can be okay. If it's just you taking your manager out for lunch for a meeting or something like that, that would be seen as client entertaining and is not tax deductible. And then after this, I just wanted to talk about capital expenses. So these are your larger expenses that contribute to the furtherance of the business, but they are more inclined to last you over 1 year. But usually treat these at usually £100 plus. So for example, if you bought a laptop, drum kit, desk to work from in a valid home office, that would be claimable. With this kind of industry though, some of that can be argued as personal. So say, for example, you bought a new phone, you do a lot of work on your phone, as a new phone, fine. HMRC will still say you probably do use that personally as well. So again, we do adjust for that, but we do let you know the personal usage adjustments, and we speak to you on that and get your guidance on what you believe should be that as well. So that applies to things like laptops as well. I do just want to also talk about the difference between a capital expenditure and what would be classed as an investment. So if you were to buy a new guitar to actually play at gigs and stuff like that, that would be capital expenditure. If you bought a really fancy guitar that you're not really going to play, it's kind of like a display piece, that would be seen as an investment because it's not really for the furtherance of your business. It's just kind of for you. It's like when people buy classic cars. They wouldn't need a classic car for their business. It would be more for them just to kind of have that as a hobby. So that's how that would be treated as an investment. However, if you were to potentially sell that invested item and are lucky to make a profit on that, which I'm sure a lot of items do go for that, we can do that. It will be a capital gain or a capital loss. So if you just keep us up to date, or keep a note of when you purchased things and how long for when you bought them, what the cost was, and any repairs to it as well. So we had a client once that bought a piano that was Elton John's, didn't really pay it, and we had to treat that as capital gain because I was just an investment on that half. Another thing to highlight as well is the difference between depreciation and investment allowances. So in your accounts, you may see an expense called depreciation. Depreciation is an accounting treatment, not a tax treatment. And what that does is it tries to reflect the current value of that capital item or fixed asset, as what we call it, over a period of time. So, for example, a laptop again, you spend about 1,200 on the laptop. Things like that, we kind of depreciate over 3 to 5 years. We'll just keep that a bit simple. We'll do 3 years. In your accounts, you'll see a £400 cost of depreciation. So that would show first year the value of the laptop being 1,200, the value of the laptop the second year being 800, third year 400, and then the fourth year after that it would be fully written off. So it's just a kind of way to keep your balance sheet and your assets at a manageable level, because as soon as you buy something, it doesn't necessarily keep the value. However, against that is the investment allowance. This is the tax deduction that is made in the tax return. You won't see this in the accounts, they are done separately. The AIA, or the annual investment allowance, is where it should be treated. This is usually the full cost of the item, or if it's like my laptop, say 70% of the item and the 30% will be treated as personal. It's just important to keep the differentiation between the two of them, because one is an accounting treatment, one is tax treatment, and they are slightly different. So now I just wanted to touch on foreign income and withheld tax. So with this, when working abroad, you may get your tax deducted at source. This is down for you to keep track of, to let your accountant or tax advisor know at the end of the year. And then what we will do is we will look at where the taxes deducted from, and see if there's a double taxation treaty, and see if we can get the relief off of your UK tax return. So what we do in that is when we complete a tax return, we have to do a separate profit and loss from the accounts to work out what your actual profit was for the foreign income. Off that, we will deduct, say, you have your turnover, which is your gross income. Off that, we'll deduct any commission, travel costs, subsistence costs, stuff like that, and we'll come out with a profit for your withheld tax. From that, we then work out what your effective rate of taxation is on the overseas profit. And from that, we further that, and then we also do that to work out the paying of withheld tax. We can offset UK tax return based on the rate of UK tax being paid. So again, that will vary on tax bands, which I will cover shortly. To offset getting your foreign tax deducted at source, you can apply for an A1 certificate, also known as a certificate of coverage. There's a form to fill out for this. You can ask your accountant to do this for you, or you can do it on your behalf. I would recommend potentially getting someone to just double check it for you once applying for yourself. We have had a client that got 2 letters of national insurance wrong way around, and it caused it to delay getting a certificate by 6 months. So just double check if you are submitting it yourself, everything is correct. So when you get this certificate, it will stop the social security deductions, and it will say you'll do that in your home country. And once the A1 form is obtained, future, but current turnaround is expected between 4 weeks to 12 weeks. Another thing to note on this is you will need a separate A1 form for each separate production. So say you went on tour to France, sorry, say you went on tour to the US with one production and 2 months later you're going on tour again in the US with a separate production, you would need a separate A1 form for each production. It wouldn't just carry over. So it is important to make sure you are on top of it. And now I just wanted to touch on student loans. There are now many a student loan. As you can see there, 1, 2, 4, 5, and postgraduate. So you will have to repay your student loan when you reach a certain level of taxable profits. So again, this isn't on your turnover, this is based on your profit after tax deductions and capital allowances. So you can see the plan 1, 2, and 4 are at 9% over those thresholds, and the postgraduate is at 6%. The payments for student loans are included in your tax return, so you won't get, you'll be told the amount of student loan you need to pay, but you will make it all in one lump sum when you pay your tax bill at the end of the year. You don't have to make 3 separate taxes for income tax, national insurance, and student loans. It's all done in one. HMRC will sort out the apportionment on your behalf. I do just want to highlight though that some people will try to make voluntary student loans in the year to try and reduce your student loan liability at the end of the year. That does not work for student loans. If you make any voluntary contributions, they are voluntary. HMRC will still expect you to pay the set amount of 9% based on the threshold, regardless if you make voluntary contributions or not. So pensions and deductions. In this industry, we can find that pension comes in the form of both taxable earnings and taxable relief. So on income slips, remits, or invoices, pension will be shown separately from basic pay from your trade. So on your slips, you will see basic pay, potential holiday pay as well. It will be separated out into reimbursed expenses, per diems, and you'll also see a line for pensions. This is them kind of paying you the pension that they are eventually going to pay over to above. So when money is paid into a pension by you through an agency, because some agencies will do a pension contribution on your behalf as well. This is claimed as a tax relief, though this is not an expense to your sole trade. HMRC does encourage pension contributions to go towards your retirement. The percentage relief is based on your tax band. So basic rate is up to 50,000, and after that higher, and then after 125,000, I believe it is 45. So at 20%, every £1 you get 20% discount, 20% extra. And donations with gift aid are another form of tax relief that is also worth mentioning. So for every £1 you donate, you do receive £1.25 in relief. These reliefs don't come in the form of a deduction, they come in the form of increasing your basic rate band. So your basic rate band will be higher and increased, so you'll be taxed more at 20%. And so, for example, up to 37,500 after your personal allowance, you'll be taxed at 20%. With these reliefs, that 37,500 will increase. So say if it increases to 40,000, that difference you'll be taxed on the basic rate band at 20% rather than 40% of the higher rate. But a note to be aware of the donations as well. If you don't earn enough to pay tax, you will have to pay over the gift aid donation difference to that HMRC on your tax return. This is because the relief is deductible based on you paying tax. So if you're not paying tax, HMRC will want you to pay that over. Okay. So limited companies versus sole traders. You might want to know what the benefits are of incorporating and being a sole trader. So they are taxed differently. Pensions are an expense for a limited company rather than boosting your basic rate band. But for a limited company, you're taxed on your profits for the accounting period. For the 22-23 tax year that's gone, that we're filing for now, it's 19% on profits. So for 23, 24 onwards, it is becoming a sliding scale. So any profits under £50,000 are 19%, any profits of £250,000 plus are 25%. And in between that is a sliding scale of a percentage of the calculation to work that out. So if you are a listed company, it probably is best to seek advice on that. Running a limited company does have some tax saving benefits, but it does come with extra responsibilities and costs. So the costs of a limited company are, for an accountant, are setting up the company. This is also creating the share rights and the incorporation. Annually, you'll have to file a confirmation statement, which is just kind of saying you or the directors are still directors, any address changes, any share changes. And that has to be filed once a year. Annual accounts do have to be filed with Companies House and HMRC. When you file a set of accounts with Companies House, it does come with, it does show your balance sheet, so your assets and liabilities and your net left over. Depending on your accountant, you can speak to them on what is shown and how minimal and how much it does show. The CT600, which is the company tax return to be filed with HMRC. And because of the tighter rules and regulations preparing those accounts, it usually does come up our accountancy costs to that as well. So in terms of admin life, a sole trader is easier to run as it only needs a tax return submitted once a year. Just to go over the basics of your personal allowance, the 22-23 tax year. The personal allowance is 12,570. After that, there are 3 tax rate bands. Basic rate going from 12,571 was 20%. After that, 40%, and above that, 45%. It is just a note to be aware of as well. Any income over £100,000 profit, you will start to lose your personal allowance at 50p per pound. So at 125,000, you will lose all of your personal allowance. So that kind of benefits being a limited company. You can kind of control what you kind of would have to spend dividend salary wise. And there are 2 types of national insurance as well. There's class 2, which is £3.50 a week. Again, totaling £162.80. That's for profits of 11,908. And for class 4, is where it's based on your actual profit as a percentage. So the upper limit, or the lower limit, sorry, is anything over 11,908 and 9.73%. And the upper profit limit starts at 50,270, and that's at 2.73%. So yeah, this is what I was referring to earlier, is taking out money from the company. You can kind of be a bit more control of that. It does ideally need to be reviewed with some tax planning. So with tax planning, what we do is we try and keep you at a basic rate band or a higher rate band to try and keep your personal allowance. Things that do impact this are income outside of the company. So salary for a PAYE job, or royalties from work as a sole trader or incorporating as a company. These can go towards your assessment and your personal allowance. So it might be that issuing a salary for the company is tax deductible for the company, but for your personal tax return, it doesn't make sense to do that. So it is all about just getting the full picture. If you do have a personal allowance to spare, it is worth taking a salary, as it does reduce profits, therefore the tax bill. And again, it is a big by the 1 point. Dividends are money you pay yourself from the company, and these are taxed at a lower rate for the 22-23 tax year. Basic rate payers pay 8.75%, higher rate 33.75%, and additional rate taxpayers pay 39.35%. For 22-23, when you take out dividends, you do receive a further £2,000 tax-free dividend allowance on top of your personal allowance. For 23-24, this is being reduced to £1,000. And another benefit of a limited company is that it's a separate legal entity. So you as an individual are separate legally from the company. So say, for example, a bricklayer, if he was going to get sued for his work for the company, and the company would take the hit. If he was a sole trader, they would sue him in his entirety, and it'd be all of his net worth. I don't think that benefit is quite as beneficial for you guys as it is for them, but it is just something to point out. And I just wanted to mention as well the deadlines. So the 31st of January is when your tax bill is due, and that is after the 5th of April before it. So for example, it's 5th of April 23, your tax bill is now due 31st 2024. But again, it's rapidly approaching. And if your tax liability is over £1,000, HMRC will ask you to start paying towards next year's tax liability as well. So what they will do is they'll, first year, if this happens, they will split your payments on account for next year into 2 payments. First payment being due on the 31st of January 24, with the second being due on the 31st of July 24. So these payments go towards your 23-24 liability, and then when the tax return is done, and it comes to 31st of January 25, it just means you either have to pay the balancing amount or get a refund if you overpaid. So that's why they do that. But unfortunately, the faster you do it, it is a bit of a sting. Corporation tax, if you do incorporate into a company, is due 9 months and 1 day after the company year end. So, for example, 31st of March 23 will lead to a tax liability due to be paid on the 1st of January 2024, and they are quite strict with that. And if you're VAT registered, and that is due 1 month and 7 days after the VAT period. VAT periods are usually 3 months at a time on a quarterly basis. Your first VAT return, though, could be a different amount of time. I have had one that backdated 7 years. We have had one that are 2 months and then go on to quarterly. It depends on how you register, if you backdate, and what the back quarters you pick. Finally, the discount opportunity that we are offering at Streets. We are offering a discount to ISM members for the 22-23 tax return. For new clients to come with us, just have to get in touch with myself or Mark Carr via email or call. If you can get your records to us by the 8th of December, we will offer a 10% discount on the tax return. So this gives you 2.5 weeks to get in touch and your records ready. So my contact details are there, offices, and I believe in the chat there will be a link to my company profile where you can get my email, LinkedIn, and get in touch however you'd like. So at Streets, we do appreciate that there's more to accounting than just numbers and technical knowledge. What we try and do is we try and have a human approach. We won't just throw buzzwords at you. We will try and make sure you understand the language as it is. It's kind of a language jargon. We hope we add value for providing our services. We try and do more than once a year, so we try and keep up to date monthly or quarterly, especially if you're kind of getting close to that back deadline. You want to get your notice as soon as possible, so there's not a big chunk to backdate. And also, if you're a limited company as well, it's always worth getting in touch with the accountant just to make sure you're not overdrawing your own account. Separate tax, being overdrawn if you're taking too much money out of the company that isn't yours to take, or buying a car for a company so we can advise some P11D treatments and actually let you know the full cost of what it is to a company. So we try and build a working relationship with you so you're comfortable with us to let us know so we are acting rather than reacting. And again, I just do have to close with that. Again, this is general guidance. It can change year on year, and it can change person to person based on the income they're earning and the deductions they're taking. And that's it from me. So back to Ruth for the Q&A.
Fantastic. Thank you so much, John, for that presentation. It was really useful, and I think we've all learned a lot. We will be sharing the recording and the slides with you all afterwards, so you'll have a chance to watch that back and check the slides if you would like to clarify anything. We're going to go through some questions now. We've had lots of questions submitted in advance and a few submitted during the webinar, so do keep asking questions and we'll try and get through as many of them as possible. John, we did have a comment about someone saying that they can't hear you very clearly. So if you could try and come a bit closer to the camera and speak as clearly as possible, that would be great. Thank you. So first question, you mentioned free agent. Do they have a photo receipt function?
The photo receipt function, the best way to do that is through Dex, which is a separate software. From my experience, that's just the one that best picks up all the data. You can take a picture and upload it to Free Agent yourself. It's a bit more admin time and it doesn't actually make it as a bill or pick up any VAT. That's all manually you have to do. So if you can get Dex, I would recommend it as it keeps electronic copy as well.
Okay, thanks. Someone asked, how much more tax does a person pay if they work for a company and are self-employed at the same time?
It's a good question. Again, that would depend on what kind of salary they're earning to get into what tax bracket, how much self-employed income they're earning, again, could make them go into another tax bracket. It could be you can deduct the expenses to get a lower profit on your self-assessment, and with claiming expenses as well, like use of home, you do have to be careful you're not using them for work. You have to keep them separate, church and state, so you're not double claiming anything. It's a hard one to say because I wouldn't know the background of it, but yeah, it would increase your tax bill. Yeah,
I can see there's lots of variables there. Perhaps this one's similar. Someone asked, how do you put through taxes when you do freelance work in different industries? Is there anything to be particularly aware of if you're working in different sectors?
It would depend on the sector. So, for example, if you're being a subcontractor in building work on the side whilst also being a musician, self-employed contractors, subcontractors will have to register as CIS contractors, and they will get CIS deducted from their pay, and that will get paid over to HMRC in advance, and then that will be just a deduction of what they owe, and then they'll pay the balancing figure. It is worth speaking to someone in that industry, depending on what they are, because there might be separate reliefs for one industry that there's not for that. So there's theatre tax relief, theatres that just standard musician doesn't get. So it's worth just checking and seeing what you can get.
Okay, thank you. And we had another question. Someone asked if they receive an honorarium, for example, for conducting a choir, do you need to input that or explain the honorarium in your tax return?
I would not be sure on that, to be honest. I would have to look that up. But if you want to drop me an email and give me some more details on that, I could answer that for you.
Okay, we'll try and follow that one up after the webinar. I know you spoke about foreign income or income generated in other countries. There was a question about working on cruise ships. So if someone's working on a cruise ship, does it matter if the company is a British company or not? And do you still have to pay tax even if you're not in a British territory? And if you do, would that just be included under your tax return with other income for the year?
So that is the big question. Again, that is something that does depend on the contract, because different cruises have slightly different variations, and some may be British, some may be not. So it would depend on how it's treated. The way we would treat it is by looking at the seafarer's allowance that you'd get. For that, you do have to be on the cruise for a certain amount of time in the year. And if you leave the cruise, you do have a certain amount of time to get back on the cruise, on another cruise job, for it to continuation for the year. So, for example, if you are on a cruise for 4 months, you have half that time to get back on another cruise job for the year, for it to be qualifying for seafarer's allowance. If you go over the 2 months, even by a day, it does reset the period that you need to claim for, and then it would be down to UK company, foreign company expenses, stuff like that. But if you can get it on there, back on the ship or another ship, it doesn't have to be the same production, they can be separate, you can claim seafarer's allowance. And there should be a link in the comments there.
Yeah, I think Ella's popped a link in the chat. Thank you, Ella. How does it work if my income varies month to month when doing a tax return?
So your income for a tax return is done for the financial year, usually from the 6th of April 22 to the 5th of April 23. So the 6th of April to the 5th of April next year. It wouldn't count on a monthly basis. It would be the annual total. And again, the expenses would be the annual total. So it'd be an annual profit figure. It's kind of like a snapshot in time of what you've done for the year. That's how it'd be taxed. If you jump over the VAT registration threshold in 1 month because you just got a massive contract, and then after that, for example, you were to go down, you can let HMRC know it was a one-off, and they can decide whether to give you leniency and to not register you and give you like chance to say it was a one-off, it won't happen again. But yeah, tax-wise, it's an annual thing. VAT is where you've got to be careful with that.
Okay, thank you. We've had lots of questions about expenses, as I'm sure you'd expect. Someone asked, am I required to pay tax on my income used to pay for work-related items such as a teaching space or room, work vehicle or car insurance? I know you talked about travel expenses, but what about some of those bigger purchase items?
Yeah, so if you're a music teacher, for example, and you are hiring a space personally, that would be a valid expense. If you are being hired by someone and they're providing the cost of the classroom and it's a regular place of work for you, travel there wouldn't be allowable because it would just be seen as you getting to your job. If, for example, again, you're in London and that's your regular place of work and you're offered a teaching role in Manchester for a couple of days to a week as a kind of one-off, you'd be allowed to claim that travel expense. But if it's just you going to your day-to-day, no. Work vehicle, it would depend on the situation. Personal allowances, again, how many people are using the car. So that'd be more detailed, something you'd have to discuss. But in terms of teaching spaces, teaching supplies and stuff like that, if you're covering the cost, yes, you can deduct that.
Okay, thank you. And a question on travel expenses. You mentioned buses. Someone said, with most buses going contactless, how do you get a receipt or prove that you got the bus? That's a good question.
Yes, that's a difficult one. For stuff like that, I think you can just, if you give your accountant the bank statements, you can prove that you got a bus on that day. If it's a working day, for sure that'd be allowable. Because, you just don't get, you can hardly really get receipts anymore unless you go to the actual front, tap on and ask for a receipt. So, there are allowances there. If you're getting a taxi, for example, though, you should try and get a receipt. Most taxi drivers will give you a receipt.
Yeah, okay. Is it possible to claim overnight stays if someone is travelling between a school they're employed with and a school they work with as a sole trader?
If it's a school you're employed with via PAYE, probably not. If it's a school you work with as a sole trader, if it's your regular place of work, again, unfortunately not. But if it was one where you were sent to for like the one-off, then you could claim that. That's how that would work.
Okay, thank you. And Robert asked, he said, if I buy a charging point for an electric vehicle in the year before buying the vehicle, how would I write that off against tax?
I think for that, HMRC would, I'm assuming for this question, you're buying the electric vehicle at home and you haven't got an office. But if it is just at home and you're installing the electric vehicle charging point at home, HMRC would view that as you getting an electric vehicle for your home. So unfortunately, the charging point wouldn't be able to written off. There is a mileage rate for electric vehicles. It is lower than 45p because the fuel cost is lower as well. In theory, there's cost of living crisis at the moment. Well, it's the same, but you can claim mileage, but you wouldn't be able to claim the electric vehicle point unless it was a dedicated office you're installing this.
Okay, thank you. That makes sense. And there was a question about claiming capital allowances on the purchase of musical instruments abroad. So the example was the purchase of a viola bow in Ireland. Would that be tax deductible?
If it's I'll give two examples for this. If you're in the UK and you're just purchasing a viola from Ireland or anywhere, yes, capital allowance. If you mean you're in Ireland and you're purchasing it, I believe the rules are similar and it's yes, but it would be best to check with an Irish accountant as there are some very slight variations in the rules.
Right. Okay. And final question on expenses. Can you claim attending other concerts as a marketing and research expense?
So this one is an interesting one. HMRC will try to say no. As specialists in the area, we say yes. The middle ground is yes and no. You can claim it. There will be some sort of personal element to it because, like with Spotify as well, another research cost. It is seen as something people do for enjoyment, not just a business transaction. So we can claim some of it, not all of it. And then again, it does depend as well if you're sponsoring the event. That also, if you sponsor the event, you're more likely to be able to claim the full amount.
Okay, thanks. And then we had a question about setting yourself up as a sole trader. So they asked, is it worth setting yourself up as a sole trader as a producer so you can buy music equipment? And if not, when's the best time? I guess that sounds quite dependent on the situation.
So setting up as a sole trader is just registering for self-assessment, to be honest. It's the same kind of thing. It is if you're planning on purchasing the stuff and then in a year or two you're hoping to make a profit, it's worth registering just so you can get the loss and then you can carry forward that loss against future profits. Or if you've got a PAYE job at the time, you might be able to claim that loss against your PAYE income and get your tax refunded.
Okay. Thank you. A few questions on income. How does grant income over £1,000 from Creative Scotland or PRS or Help Musicians get treated if you're self-employed?
That is a grant by grant basis, and they will tell you if it's taxable or not. If it's taxable and it's over £1,000, we need to register. If it's not taxable, then it's not taxable. It doesn't need to go on a self-assessment. They usually do tell you, usually if it's purely for your, so we had a few in the pandemic where they were just purely ones for cost of living help. They weren't taxable because they weren't to go towards any expenses for the furtherance of the trade. They were just kind of for survival. But if they're to go towards the furtherance of the business, they usually are taxed.
Okay. And do international streaming and sales count as foreign income?
That one, it usually does count as UK because it's a UK production. It just won't go towards your VAT threshold. Okay. So it will be fees overseas that you've earned from the UK. So it will go into your self-assessment, not your foreign pages, but it won't go towards your UK VAT threshold.
Okay, thanks. Someone asked, how should I report foreign income which has not been taxed at source? For example, a US orchestra commissions me to compose a new piece and all of the work is completed in the UK, but the income source is in the US.
It would depend on a few things, if that would go on your foreign page, or if that would go on your UK income. If it's a US production paying you, it would go on the foreign pages and you would just have to fill out on the foreign pages any the turnover and any expenses allocated to it to get the profit on that. If it's a UK production, but it's overseas and it's paying you in dollars, if it's a UK production, it goes on your self-assessment, self-employed income.
Okay, thanks. And then you mentioned A1 certificates. Someone asked, someone commented that it can take months to get an A1 certificate. And if SS deductions are made, can they claim a refund when the certificate arrives?
So unfortunately, a refund can't be claimed. When your tax return is being completed, we will fill out the foreign tax pages and we will also fill out the tax deducted on the foreign income, and we will deduct that off your UK tax return based on the percentages we can claim.
Okay, thank you. We've got one of our registrants who's based in Scotland and asked if you could just clarify any differences between the systems in Scotland and England, and perhaps if you could touch on Northern Ireland and Wales as well, that would be really helpful. If that's not too much to ask.
There should be a link in the chat for Scottish taxes. For Scotland, it's only different on self-employed income. For dividends and everything else, it's the same. See the links in the chat now for Scotland. For Ireland, again, I believe the best thing to do would be to speak to an Irish accountant or a Scottish accountant, just because it might not be just the percentages that are different. There may be some slight variations in rules. With tax law, there's three kind of regions. Scotland is one, England and Wales is one, and Northern Ireland and Ireland are their own. So they all have slightly varying ones.
Okay, thank you. Someone asked, if we have an agent and they take a cut from our payment, can we declare the agency fee?
Yes, so in your tax return or your accounts, you'll have a fee income. That will be the gross fee income that you earn. And then in your cost of sales section, you will have commission deductions is where you put that. And then you should have your gross profit should be the amount you receive in the bank. And then after that, any other deductions would be your profit.
Okay, thank you, John. I'm afraid we're out of time. So if there are any more questions, we'll try and answer them afterwards. But I just want to say thank you very much to John for that extremely useful overview of tax for musicians and for fielding so many questions so eloquently. Well done. And thank you to all of you for joining us. I hope you found the session informative and useful. And if you have any further questions, please do email us on inquiries@ismtrust.org. And please do fill out our post-webinar survey, which you can find in the chat, and it will also be emailed out to you. We really appreciate your feedback. It helps us to improve our services and to offer you more free professional development. The webinar recording will be sent out to you by email, and it will also be available to watch on our website. And we'll also be sending you some useful links that have been shared during this webinar. Our next online event is on the 7th of December, when we have an online workshop on building a successful freelance music business. And then on the 17th of January, we have an online workshop on synthesis in music production to deepen your understanding of sound generation. So I hope that you'll join us for some of those events. And finally, can I just say thank you very much again for watching. And we hope to see you at another ISM Trust event soon. Thank you very much. Goodbye.